we as a firm, and again, I think we're fairly clear on some of the things that we put out there into the world, are sometimes, or quite often, slightly wary of active management simply because the costs are higher. There's a lot of evidence that suggests that a passive approach is better from a pure performance perspective we're talking here. Now, much as we don't tell our clients that they have to invest ethically or they have to exclude anything, we don't ever impose anyone's values on our clients. We say it's your money, it's your choice. We will find a solution regardless of what you come to us with. That doesn't mean that we don't have a view. And we have clients who are invested actively and paying that extra money, but typically it's because they want something very bespoke, very unique, something that can't be delivered by a passive investment. Now, I know you as a firm have both. You have one foot in each camp. You have passive solutions, you have active solutions, but I'm just really interested to hear where you see the value is in active investment management, and why is it worth a client paying a bit more sometimes?
Sure. Big question.
Yeah.
I think passives and actives have a role to play in sustainable investing, but you can only go so far in passives because what you are reliant on, which is fine, and that's some of the benefits that you yield from it, for example, the low-cost approach, is that you're really reliant on data, published data that is being translated into rules that then construct what you end up investing in. So sustainable investing can only go so far in using specific public data and achieving some sustainability outcomes. What you can do with passive investing is you can quite easily exclude things that you really hate if it's a specific business model. But going back to those nuances that we just talked about, certain businesses need to be really in-depthly analyzed to understand their holistic impact. That's kind of where the gray areas, if you will, is where sometimes an active lens still has some value, because you need a human with the help of data, but also the help of judgment and the help of being able to talk to a business and kind of tease those nuances apart. Sometimes that's when you need it. We don't think you can yet do positive impact investing with a passive approach, because you need to be able to contribute to impact through either direct engagement or this really holistic assessment of a business and its products and services. But you can go far with passives as well. I just think if you need to be aware of some of the trade-offs that come with over-reliance on data and a data-driven approach, especially when there's going to be less disclosure in the future. But then also, of course, the drawbacks of a human making potentially right decisions, but also sometimes mistakes. Another differentiator between passives and actives is the level and depth of stewardship. So if you are an investor that really cares about that change, you can vote in a passive approach, and we do that. We only go with fund managers that actually have a very strong voting track record. But you can't expect with all of the assets underlying a passive investments that there's going to be an engagement with every single one of them, right? Because you're paying less fees, there's less people working on them, there's going to be less engagement. With an active fund with much less securities underneath and a dedicated team, you can expect there's going to be a bit more active in that. So pros and cons on both, and different futures ahead for sure. AI is going to change this quite widely, probably bring down the cost of these data aggregations, for example, and be smart about how we make data-driven investment decisions. But
great.